Before you deposit a single penny into any trading account, you need to understand how to choose a broker, because the broker you trade with affects everything, from your spreads, your execution speed, your withdrawals, and your protection if something goes wrong. And yet, most beginners just Google best Forex broker, click the first result, and sign up without asking a single question. Please do not do this. This is your hard-earned money we are talking about, so you should be 100% informed and understand where that money is going and how exactly it will be used. It's a big mistake not doing your research before committing to a brokerage. And in this video, we're going to make sure you don't make it. We are going to go through all the things that matter and that you need to be aware of when picking a broker, so you can have the confidence and skills to make the decision for yourself and your own situation. My goal in this video is to guide you on how to get the relevant information you need to make a fully informed decision about who has the privilege of handling your money. I want to be upfront about something first. This video has no sponsored recommendations. I'm not going to tell you to sign up with a specific broker because they're paying me to say it. What I'm going to give you is the framework to evaluate any and all brokers for yourself, so you can make an informed decision based on your own situation. Now let's go through what actually matters. The first thing you need to understand is regulation. There are two types of brokers, regulated and unregulated. Both have their pros and cons, but if you are new to trading, I strongly suggest you find yourself a regulated broker. So let's dive into what exactly a regulated and unregulated broker is. A regulated broker is one that is overseen by a financial authority. These are organisations like the FCA in the UK, ASIC in Australia, SISEC in Cyprus, or the NFA and CFTC in the United States. Their job is to make sure brokers operate fairly, keep client funds separate from their own money, and have processes in place to protect you if the broker runs into financial trouble. On the other hand, an unregulated broker has none of that oversight. There is nothing stopping them from manipulating prices, delaying withdrawals, or simply disappearing with your money, and it happens, more often than people realise. There are very, very, very few remotely trustworthy unregulated brokers out there. So if you are even potentially considering one, please do your research on that specific broker extremely thoroughly. For the sake of simplicity and peace of mind, and especially if you are new to trading, I suggest you find yourself a regulated broker. So how do I research which broker is best? When you're evaluating a broker, go to their website, find their regulatory information, and then go directly to the regulator's website and verify it for yourself. Don't just take the broker's word for it. Fraudulent brokers have been known to fake regulatory credentials. 2 minutes of verification can save you everything. As a general rule, FCA and ASIC regulated brokers are considered among the strongest in terms of client protection. If you're based in the UK or Europe, these are the ones to prioritise. Quick disclaimer, I'm not a financial advisor. Everything is for educational and entertainment purposes only. This is not financial advice. Trading involves significant risk. Always do your own research and only risk what you can afford to lose. Now, the second thing to look at is spreads and commissions. The spread is the difference between the buy price and the sell price of a currency pair. You may also hear this as the bid and ask price, and this difference is one of the primary ways brokers make money. Every time you open a trade, you're starting slightly in the negative because of the spread. The tighter the spread, the less you need the market to move in your favour before you're in profit. There are two main types of broker accounts you'll come across. Standard accounts typically have wider spreads but no additional commission. ECN accounts, which stands for Electronic Communication Network, tend to have very tight spreads, sometimes as low as zero, but charge a commission per lot traded. Neither is automatically better. It depends on your trading style. If you're scalping and taking lots of small trades, tight spreads with a small commission can work out cheaper overall. If you're swing trading and holding positions for days, a slightly wider spread on a standard account might be perfectly fine. The key is to calculate the real cost of trading on each account type before you commit. Look at the average spread on the pairs you plan to trade and factor in any commissions. That's your cost per trade. Many brokers offer demo accounts, so you can test these things out for yourself before opening a live account. Third is swap rates, also called rollover rates or overnight fees. When you hold a Forex position open past the end of the trading day, which is typically 5 p.m. New York time, you either pay or receive an interest charge based on the difference in interest rates between the two currencies in your pair. This is called the swap. For some traders, this is a minor consideration. For others, particularly swing traders who hold positions for days or weeks, swap rates can be a significant cost that eats into profits over time. Some brokers also offer swap-free accounts, sometimes called Islamic accounts, which are designed for traders who can't pay or receive interest for religious reasons. If that applies to you, it's worth checking what the broker offers and whether there are any alternative fees attached. Always check the swap rates on the specific pairs you plan to trade before opening an account. Most brokers publish these on their website, or you can find them directly in the platform. The fourth thing is platform compatibility. This should be straightforward, but it catches people out. Most serious retail traders use MetaTrader 4 or MetaTrader 5, also known as MT4 or MT5. If you're using Tradingview for your analysis and MetaTrader for your execution, which is a very common setup, you need to make sure your broker supports the MetaTrader platform and that the connection is stable. Some brokers have their own proprietary platforms. These can be fine, but they add a learning curve and can limit your options when it comes to tools, expert advisors, and automation down the line. Unless there's a very specific reason to use a proprietary platform, I'd stick with a broker that supports MT4 or MT5. Also, just a personal suggestion, both of these platforms are low-key prehistoric, they look very similar, but I would recommend going with MT5. It's newer, mostly because MT4 is quite buggy and more difficult to use. There are also way more tutorials and information online for how to use MT5 if you get stuck with anything. Fifth, we have deposits and withdrawals. This one should be obvious, but it's surprisingly overlooked. Before you make a deposit, you must check the following. What are the available deposit and withdrawal methods? Bank transfer, card, PayPal, Skrill, crypto. Make sure at least one of them is convenient for you. Also note that just because you can deposit with a certain method may not necessarily mean you can withdraw with the same method, just something to keep in mind and triple check. What are the withdrawal processing times? A reputable broker should process withdrawals within 1 to 3 business days. If you see reviews online of people waiting weeks to get their money out, that's a serious red flag. Stay away. Are there any withdrawal fees? Some brokers charge a flat fee or a percentage for withdrawals. It's not necessarily a deal breaker, but you should know about it before you're on the other end of it. And what's the minimum deposit? Some brokers require $500 or $1,000 to open a live account. Others let you start with as little as 10 or 20. If you're just starting out, a lower minimum deposit allows you to trade with a small amount while you're still learning, without putting a large sum at risk. Number 6 is the execution quality. This is harder to evaluate before you open an account, but it matters enormously once you're trading live. Execution quality refers to how quickly and accurately your orders get filled. I suggest opening a demo with the broker you are considering to get a better idea and feel for this. 2 things to watch for here. Slippage, which is when your order fills at a different price than the one you requested, usually because the market moved in the fraction of a second between you clicking and the broker executing. And requotes, which is when the broker comes back to you and says, the price has changed. Do you want to accept the new price? Frequent requotes are a sign of a broker with poor execution infrastructure or low liquidity. The best way to assess execution quality is to read genuine user reviews on independent platforms, or to open a demo account and test the platform before committing real money. Now, let me cover a few red flags that should make you walk away immediately. Any broker promising guaranteed returns or guaranteed profits. No legitimate broker makes those promises. Trading involves risk. Anyone telling you otherwise is lying. Pressure to deposit more money. Whether it's through customer service calls, emails, or pop-ups, a broker pressuring you to deposit larger amounts is a manipulation tactic. A good broker lets you make that decision on your own timeline. Difficulty withdrawing funds. If you see consistent complaints online about withdrawal problems, delays, excuses, sudden account issues that appear right when someone tries to take money out, that broker is almost certainly not to be trusted. Unverifiable regulation. As I said earlier, always check the regulatory details yourself on the regulator's official website. Don't rely on logos on a web page. You deserve better than that. Seek the truth for yourself. And finally, if it feels too good to be true, it probably is. Extremely high leverage with no risk warnings, bonuses that come with impossible withdrawal conditions, spreads that seem impossibly tight. These are tactics used to attract deposits. Be skeptical. Be cautious. If it walks like a scam and talks like a scam, it's probably a scam, which, sadly to say, this industry is full of them, not just fake brokers, but completely across the board. It is one of my main motivators for starting this channel in the first place, to help people navigate the trading industry the way I wish someone could have navigated it with me when I was first starting out, instead of having to learn everything the hard way. Ignorance is not bliss in the trading business. It's a killer. It's my personal goal to help traders, especially beginners, avoid the painful pitfalls and costly mistakes all too common in the trading industry. So to put things all together, when you're evaluating a broker, run through this checklist. Are they regulated by a reputable authority? And have you verified it for yourself? What are the actual spreads and commissions on the pairs you plan to trade? What are the swap rates for overnight positions? Do they support MT4 or MT5? What are the deposit and withdrawal options, fees and processing times? And what do real user reviews say about their execution and withdrawal reliability? Take your time with this decision. The right broker won't pressure you, won't promise you anything unrealistic, and will be completely transparent about their fees and conditions. That's the baseline. Everything else in trading, your strategy, your analysis, your risk management depends on having a solid, trustworthy broker underneath it all. Get this part right first. In the next video, we're going to tackle something that confuses almost every beginner: the difference between a prop firm and a broker. Because they are completely different things, they work in completely different ways, and mixing them up can lead to some very expensive misunderstandings. See you in the next one.